bring in Kumar, the CEO of Value Research. Dhirendra, thank you so much for joining us. It's a pleasure to have you on the show.
Thank you.
Now, in reaction to the show that we had done a few weeks ago when we talked about the impact of the 7th Pay Commission and all of the extra money people will likely have in their bank accounts starting the 1st of January, we got a question from 26-year-old Vivek Kumar. This is our portfolio question for the day. Now, Vivek writes in saying he wants to build a corpus of 20 crore rupees for his retirement, which is impressive, and 70 lakh rupees for a flat he wants to buy in the next 10 years. He says his salary is going to be hiked by about 10 to 12,000 rupees a month because of the pay commission, and he wants to know what he should do with this extra money. Now, he's making about 40,000 rupees a month. He has some insurance policies that are generating a return of 8.5%. So, that sort of tells us that it's a debt-based insurance policy, which is something we advise against, Vivek. He also has his PF deduction and 10 lakh rupees in a postal life insurance policy. And he's investing about 10,500 rupees in mutual funds every month. If we look at his portfolio at this point, he has a very ambitious goal of 20 crore rupees for his retirement. What is he going to have to do in order to hit that goal?
No, one is that if he's relatively young, so I'm hoping that he'll be part of the NPS, and 10% of his salary is going in NPS, which is matched by the government. So that also will translate into something very meaningful. That apart, I think he needs to really think in terms of saving as much as he can, and most of it in equity, and being very methodical about about his investment. And I don't think if he has 30 years time frame, it is not a difficult goal. But at the same time, if he sticks to these 3-4 principles, as and when he gets an opportunity to increase his allocation to, having the highest allocation possible in his NPS account, choosing 3-4 good funds, sticking to it, increase his allocation as much as possible, and investing regularly, resisting any temptation to, stop his investment or, withdraw his investment if the investments, if investments do very well. Because those are big speed breakers to achieve, or big impediments to achieving a long-term goal.
Well, Vivek, so what Dhirendra is basically saying is that the advantage you have is time. You have time on your hands, which is a great thing. So all you have to do is stick to the basics. And the basics are invest in equity, be disciplined, don't pull the money out, don't let anything sort of shake your faith about equity as you go on. And as you get an increase in your salary, increase your contribution. Now, Dhirendra, he's already investing about 1/4 of everything he takes home in his mutual funds. He's going to get an increased salary of 10 or 12,000 rupees. Let's go over the funds that he has. 6 funds divided among 2 fund houses, 4 of those all in SBI, SBI Magnum Global, SBI Equity, the Blue Chip Fund and the Mid Cap Fund. He also has Kanhaiya growth companies and smaller companies. Now, he might be putting all of his eggs in just 2 baskets. Do you want to, shuffle up his allocation a little bit when it comes to his mutual funds?
Yes, one is that, it's important to diversify. It is important to be in the more aggressive funds given his time frame and a very ambitious goal. At the same time, he should do without any fixed income allocation except for the emergency fund that he needs to have. And so I would say that, just hold 2 of these 6-7 funds that you have. Maybe the smaller companies fund and, the Magnum Global Fund are the most promising one. And of course, there will be also the most volatile ones. But stick to it. Stick through the volatility. Go through the, ride the ups and downs. Maybe add 1 or 2 more funds from our aggressive growth portfolio. And that should be it. And review your investments every 2-3 years, not necessarily every year. And plan your changes in a manner which is tax efficient.
But Dhirendra, the extra 12,000 rupees that he's going to get, should he spread that across the same funds as well?
Yes, the extra 12,000 rupees should be spread over the 4 funds. And, spreading beyond a point is actually a disservice to yourself, because the moment you have 7-8 different kind of funds, then you run the risk of, generating a fairly average return. If you have to achieve that, even then you are well off because you'll be riding on equity. But then you will be much better off keeping it very simple. A superior alternative, if you have to diversify in an unmanaged way, is to hold an index fund rather than, a set of funds where some are doing well, some are doing poorly. And over the long run, this diversification is not meaningful.
All right, so that's the answer you're getting. And remember, if you have any more questions, you can get back in touch with us. The fundamental learning for all of us who are investing for the long term is to keep the faith and keep the discipline. If you're disciplined and regular, then you will manage to invest successfully over the long term, and you'll write back to us to thank us in a few years. But Dhirendra, a very quick question coming from Ramadas Nayak. He says he's in the 30% tax bracket. He wants to know if he should be investing in the NPS, considering that it's taxable on withdrawal. He says his other option he's been investing in so far is the EPF. So that's a mandatory deduction. So the NPS, Dhirendra, we're still waiting for clarity on whether or not it will be taxable when we get the money back. Are you expecting a change there? And what advice would you give our viewers right now who are wondering what they should be doing with the NPS?
Yeah, I'm very hopeful that, next pretty soon, or maybe at least by the time many people will retire in 5-10 years, NPS will have the same treatment as equity. But even assuming, it is not so, but going by what exists, the form of NPS today, I would like to suggest one thing. This 80CCD 1, which has been introduced, which is the extra 50,000 rupee which you can invest to get that tax deduction or income deduction for computing your taxes. There is one way of looking at it, that 50,000 rupee will be deducted if you invest in NPS. The other way of looking at it is that if you have 50,000 rupees to invest and you pay 30% tax, you have only 35,000 rupees to invest. Compared to 50,000 on which you will get the tax break, because 15,000 which so 50,000 rupee investment in NPS is equal to 35,000 rupee investment in equity. And if you're doing it for 10-15 years and going by the current framework of NPS, I think you will be better off with 100% allocation to equity, because NPS the maximum equity allocation that you will get is 50%.
This is the advice that you're getting. Of course, you'll get that extra 50,000 rupees by investing in the NPS. But Dhirendra says it doesn't have a great equity allocation. You have maximum of 50%. You'd probably be better off investing directly in an aggressive equity fund. I'm going to put up on our screen, the multi-cap equity funds that we recommend on this show. They'll be better bets over the long term. Remember, the caveat for this advice is long term. So only if you're going to be investing like the NPS for 10, 15 years, then it makes sense to pick up one of these equity funds and invest in the exact same manner. Start an SIP and go on for the next 10 or 15 years. The big fund this week that we're looking at is the HDFC Balanced Fund. Avan will take you through the latest numbers in terms of returns of this fund, and then we'll come back and talk about it. Avan.
Thanks, Faye. This week we focus on an aggressive balanced fund, the HDFC Balanced Fund. Now, the fund has had a good long-term track record with a 5-star rating to its credit. But how does the performance look over the short term? A quick look at its performance chart shows that the fund has performed well both in the bull and the bear phases of the market. While the fund's performance has been consistent over the last couple of years, in 2014, the fund was its best, generating a return of 51%, outperforming its category and benchmark. However, its performance in the last 1 year has come down to 2%, thereby lagging behind its peers in the category. Despite having a good track record, the fund's long-term performance, however, is comparable to some of the other equity funds in the fund house. So is it time then to switch to other funds? Let's find out. With that, it's back to you, Faye.
All right, Avan, thank you for that update. Dhirendra, HDFC Balanced has been on our radar since we launched this show 7 years ago. It's been a fund, really, that even though it's a balanced fund, it's sometimes given us returns like an equity fund. It's sometimes made us nervous like equity funds do. But the performance over the last 1 year, I can imagine how some viewers or some investors might be a little worried. 2% over the last 1 year. But it's stayed with what the larger category is giving. So for someone who's looking at their portfolio right now, wondering what to do with HDFC Balanced, is it slipping, is it not slipping? What's your advice?
No, I would say that, a lot of investors once again are looking at 1 year return and getting disappointed, but one is missing the picture. Look at this fund itself. Last 2 year return, the average is 24%. Last 3 years returns, 18%. So even if you factor in this 2% return in last 1 year, I don't think that's the right way of looking at any equity tilted investment. One, ideally, as we keep insisting, as we keep repeating, that when investing in equity, if you have anything less than 5 years in mind, don't be around it. So, it's not meant for those people. So one should have that perspective, and you will get that, you will get that linear, and that linear is very important. So I would say that don't give up on this. This is an outstanding fund over most trailing period. Yes. It is little, now we have seen that there is an emergence of a very genuine kind of balanced fund, which are more conservative, which don't disappoint in the bad times, and that is the first expectation from a balanced fund, that if the market crumbles, this fund won't as much. So from that standpoint, for ultra conservative investor investing in equity for the first time, this may not be the fund. But if you are looking for a reasonable return from a relatively conservative allocation, 30-35% is mostly in fixed income in this fund, and this will also not fall freely in a dramatically falling market. So I would say don't give up on this fund. This is an outstanding fund. Don't get carried by what has happened in the last 1 year.
Don't give up on the fund. Don't get carried away by what's happening in the last 1 year. Dhirendra, for those viewers who, this is the odd portion that this fund puts us in. If I'm conservative, then I'm possibly better off investing in a conservative balanced fund. If I'm a little more aggressive, wouldn't I be better off in HDFC equity then? Where does this fund actually categorize? What sort of an investor should pick a fund like this one?
I would say that, ultra-conservative investor, first-time investor should not be investing in this fund, but investors who will get very upset with big declines in the market, they might be very happy with this fund. I would look at HDFC Balanced as an equity fund which will not disappoint in a very difficult market. So I would say an investor who is investing, I'm not referring to HDFC equity because it's a multi-cap fund. It's a fund which spreads across the markets and it tries to maximize the return. And that is my expectation with HDFC equity. But I would compare this with a conservative equity fund, so a balanced fund of similar kind. At the same time, I would also think of large cap funds, which investors go for trying to minimize the risk while optimizing the return from equity.
All right, finally, Dhirendra, very rarely do we get a fund that is low on risk and high on returns. What sort of a star rating would you give HDFC Balanced on the show?
Definitely, if one is looking at decent return from equities with reasonable stability, HDFC Balanced Fund is a good choice, and I would slot it as a 5-star fund.
All right, there you have it. It's on your screen. 5 stars for the HDFC Balanced Fund on Investors Guide. Remember, we track these funds on a regular basis. So every year we will review the rating again and we'll tell you what you should be doing. But for now, it's a 5-star fund, and 5 stars are tough to come by on these reviews. So it's a good fund that you can rely on. Let's move on to our hold or sell segment. 32-year-old Sushant has written in, Dhirendra, he wants, his first goal, he tells us, was to reduce his home loan significantly. He's now managed to do that, so he's quite happy. He wants to now focus on building an investment. He has 6,000 rupees that he's investing in mutual funds for over 3 years, he tells us, and he sent us a list of the funds. Right on top, there's the Birla Sun Life Frontline Equity. Continue that investment?
Yes, one should continue with this investment, and this is a kind of fund which you don't have to really you don't get disappointed and continue in the lean times as well. And if you're investing for 5-10 years, I think this is great time to increase your allocation in such funds.
Right, increase your allocation in that fund. Franklin India Prima Plus is the next on his list, Dhirendra. Continue that investment as well?
Yes, definitely. Prima Plus has been part of many of our portfolios. It remains an outstanding multi-cap fund. Continue with this.
Next up is HDFC Top 200. We've had a lot of viewers sort of get nervous about this fund, rethink it a couple of times, but it's always proven that over the long term, it comes out tops. Continue this investment as well?
Yes, but ensure that it is not more than a quarter of or 20%, 25% of your total allocation. Because that is the way to de-risk yourself. You will get disappointing, and now HDFC Top 200 with its change character has been disappointing. And I'm in a great, I'm faced with great anxiety. I still believe the whole hypothesis or thesis of the fund manager, but numbers simply don't stack up, and odds are quite unfavorable. It has become a fairly large fund. So we must de-risk ourselves from a very large exposure to a single fund like this. So, manage this risk. Continue your investment, but ensure that it is not more than 20-25% of your total fund.
Well, the next 3 funds in his portfolio are all from ICICI Prudential, Dhirendra, and they're funds that you recommend. There's Dynamic, there's Focus Blue Chip, and Value Discovery. Continue all 3?
No, I would suggest that, if he's investing for many, many years, he can get choosy, and he should ensure that, his 3 other funds are from different other fund families. He should choose 1 or 2 of these, and I think, if he has to drop one or two, if he has to drop one, then I would drop the blue chip fund. It's a large cap fund, and for his investment time frame, he should be in a fund which should have all the flexibility. Dynamic as well as value discovery fund has all the flexibility, but if I have to choose one of these two, I will go with value discovery.
All right, and last two funds on his list, L&T Equity and UTI Opportunities. At this point, I'm thinking he has 8 funds, Dhirendra, and 26,000 rupees to invest every month. There might be a need also to bring down the number of funds in his portfolio.
Yes, he can do without the L&T equity fund, and he's getting the exposure from the 4 other funds which he will have, and UTI Opportunity is also promising. So we can well have at most the 5 funds, including UTI Opportunity, and one of the ICICI Prudential funds, and the first 3 funds which we listed.
All right, so on your screen right now, we've consolidated your portfolio. You'll be better off with fewer funds. It's easier management, especially if you're investing for the long term. Now, if you're watching at home and you'd like us to take a look at your portfolio, write to us. Email ID is at the bottom of your screen. You can also reach me on Twitter as well. Dhirendra, before I let you go, one very, very quick question. 53-year-old Naveen Kumar has written in. He sent us his financial details. He has a term insurance policy, a medical insurance policy, and he has an emergency fund, along with a government pension, he tells us. 20 lakh rupees in mutual funds right now, 30 lakh rupees in fixed deposits. He now wants to deploy money he has in fixed deposits into equity mutual funds. And he says he needs this corpus after retirement. Now, he has a long-term horizon of 10 or 15 years. He wants to know what's the best way to move that 30 lakh rupees from the fixed deposit into mutual funds, and what would you recommend he invests in?
I would suggest that he should look at all his current investment, maybe move that also into balanced fund. Steadily, this large amount of money over the next 12 months or 18 months or even 2 years, because this money is going to be in those investments. As he is likely to get a pension, he is unlikely to depend on his investment for income completely. So choose 3-4 balanced fund, get into them methodically, ensure that you are not moving your money in bulk, in lump sum, and so doing everything steadily is very important.
Doing everything steadily is very important, and if you need some more help with your portfolio, we'll get in touch with you. Don't worry about the ups and downs, is what Dhirendra is saying. Especially if you have 10 or 15 years time horizon on your hand, you should be okay. So Dhirendra's advice of balanced funds, I'm going to put up the balanced funds that we recommend on your screen right now. You can write those down. Someone from our team will also send you a copy of the advice and the link. Of course, links to this show are available on our Facebook page as well. Dhirendra, thank you so much for joining us. We look forward to sitting down with you again next week. Let's answer questions on asset allocation. Feroz Aziz joins us right now. Hi, Feroz. Our first question comes in from a woman investor. Archita Thakur has written in. She has a 2-year-old son, and she wants to build a corpus for her son's education. Although she's not mentioned how much or whether or not she has a target, she wants you to recommend a plan that will help her achieve her goal.
See, firstly, very important to lay down your goals in monetary terms and fixing the value to it. So that's the most important aspect of trying to save for children and education for the child, because it's a very, very important goal in one's life, and that's something which can't be compromised, because that's what is an asset, your child's education. So I think monetizing it and identifying what is the kind of quantums you will need is a very important aspect. So for example, if you actually need 20 lakhs in the next 15 years, then you will have to do a monthly investment of 4,000 rupees, and if it grew at 13%, you will be actually at 20 lakh rupees. But on the contrary, if you've not monetized it and you end up needing a crore, so you would actually be making a 4,000 rupee investment and fall short by a handsome margin of 80%. In my opinion, just make sure that the monetary objective, the goals are laid down in the monetary terms, and that will help you decide and work backwards of what's the kind of quantums you will have to actually shell out from your disposable incomes to create those corpuses. So now coming to what kind of funds you can actually choose. I would say an ICICI focused blue chip fund in the large cap category could be a good fund for you to accumulate monies over long periods of time, and in the mid cap category you can look in an HDFC mid cap. These are the two funds. If combined, you will automatically have almost about 120 stocks in your portfolio because of buying these two funds. So I think these two will suffice for the time being, and as your disposable incomes go up, creating a buffer for your child's education and child's other needs is always a wise thing to do, in my opinion.
Next question comes in from 33-year-old Avinash, who wants to invest over the long term for his child. He says he wants to be equity oriented with a portfolio and 20% into debt. So what would you suggest now? See, this is the difference between a woman and a man investor. He wants to go all aggressive. Feroz, what kind of equity funds would you recommend?
It's very nice to see that you have already decided an asset allocation, which is very important, because that's what is going to be the key driving force in the maturity amount. So 80% in equity, 20% in debt. I think I'm pretty much in agreement that this is a good asset allocation from a 16-year perspective to save for your child. So that's a thumbs up in terms of asset allocation. Then moving on to the schemes you can choose to make investments. It's also very important to understand what is the kind of quantums you will require, even after factoring inflation when it comes to your child's education, marriage, and whatever you're actually trying to save up for. So make sure that you have inflation in mind and number in mind, so that you understand, work backwards, and realize how much you have left to monthly invest to accumulate. Now let me name a few funds which you can actually start your savings and investment for your child. On the large cap category, you can look at a Birla Frontline equity fund. In the mid-cap category, you can look at an HDFC mid-cap opportunities fund, and in the debt category, you can look at an ICICI regular savings fund. These three funds put together, I think 1/3 in each would be a good start point for your 16-year investment.
Last question comes in from Ramakrishna Singh, who's been investing in mutual funds through SIPs. He just wants to know if he's on the right track. He has the Birla Sun Life Tax Relief 96, SBI Magnum Tax Gain, and emerging businesses. Well, he seems to need the tax benefit, and when he's investing in an SIP, he can't take that money out right now, Feroz. And also there's emerging businesses. It seems like he's on the right track. They're good funds.
So out of these three schemes, you have two equity linked saving schemes which will have a lock-in. So you will actually be having your units stuck for about 3 odd years. But if that period is over, then there is some mending possible. Otherwise, you'll have to stay invested for long periods of time. But the other fund, which is the third fund, which is the SBI Emerging Business, is of course a fund which is liquid and which can be redeemed at your whims and fancies. So if you actually make some changes there, then definitely there is some degree of optimization your portfolio can achieve.
All right, Feroz, thank you so much for those answers. That's a wrap on Investor's Guide. You can always get in touch with us. Email ID is at the bottom of your screen. But I must share with you our brand new offering from the Times Network. We've launched Magic Bricks Now, which is a 24/7 property channel. You can tune in. You can get in touch with us on the phone, ask us questions about buying property, tax, legal, anything to do with property. All of the advice and the information is on this channel. You can watch it and let us know what you think. It'll be our pleasure to hear from you. Thanks for watching.